Okay, we're going to now start on financial management strategies, which is the last chunk of the finance topic. So we've done role of finance. So what's the key role of finance within a business? We've had a look at some of the key influences in terms of sources of finance. We've had a look at processes in terms of ratios. Now we're going to look at financial management strategies, and the strategies are about what can a business do when they identify that there are problems with a particular financial aspect of the business. What can they do to improve that financial aspect of the business? And there are key strategies in relation to each of those areas, such as cash flow management and working capital management. So this video will start off with the first strategy, which relates to cash flow management. But before we have a look at what the strategies are in relation to cash flow management, we first need to just recap on what is cash flow management and the importance of the cash flow statement, which might help to identify a particular business has a problem, and then consider what strategies could be used to improve that cash flow situation. Okay, so we have spoken a lot about the cash flow statement. There's an example of the I Wish Toys cash flow statement on the bottom left of the screen there. But the financial statement is showing cash into the business and cash out of the business. Cash in the form of cash inflows, cash out in the form of cash outflows, and then a balance at the end of the relevant period, be it monthly, quarterly, or annually. Cash receipts are money received by the business for whatever it is that business does. If it's Qantas, it's for selling tickets. If it's BHP, it's for selling iron ore or some other commodity. But it's the cash that the business has received in that relevant period. And some businesses may well have problems with their cash receipts in the sense that they might not be very good at collecting those cash receipts. And don't forget that the cash receipts will only be recorded there if they actually have the cash has been received. If they've sold something on credit, then that cash received from those items sold on credit will not be recorded until the actual cash is received. Otherwise, it would be an account receivable on your balance sheet. And the issue with cash receipts is that some of your debtors may well be very prompt and that they'll pay quickly. Others, however, might drag the chain and not pay the cash receipts for a long period of time. And that's when a business might need to consider some sort of strategy to try to speed up the receipt of those payments. And the reason being that the slow cash receipts have a negative impact on the business's cash flow and ultimately the financial position of that business. Okay, just a bit more information there in terms of cash receipts. The issue of debt collection, so chasing up those outstanding accounts, is compounded by the events in the external environment. So the external environment may well play a part in the collection of those cash receipts. If you're in a recession, people are generally going to delay payment of outstanding accounts, potentially because they don't have the cash to do so, or they just are being very cautious of making payments. In terms of payments, so we've talked about receipt, so receiving money from selling a good, but also payments to creditors when the business buys something on credit. So the business, as it says there, therefore the business must turn over stock quickly, as cash should be available to pay creditors. So a business needs to manage their cash in and their cash out. And really what a business is trying to do is get their cash in paid as fast as possible, so their accounts are receivable, and have their cash out effectively being paid as slow as possible, but still within their limits, so their accounts payable. And therefore, they would make sure that they had sufficient money from their sales, i.e. their accounts receivable, to pay off their debtors, i.e. their accounts payable. And a point there which relates to the text in red, the need for working capital management is essential. Because if your suppliers don't get the money, you buy something, if Qantas goes and buys fuel, but they're being very bad with paying for that fuel and they're taking the fuel and paying 60 or 90 days to pay for it, then that fuel company is potentially going to become reluctant to sell to them. So it's going to have an impact on their relationship. So therefore, managing your cash payments is just as important as managing your cash receipts. Business also has various payments which don't vary with output. So in order to remain liquid, a business might look at drawing up a budget to help balance out how much cash is needed to fulfill payments as they fall due. So that's all around cash flow management and making sure that you're aware of when payments or particular payments are due. Again, to ensure you're keeping your external stakeholders happy. Okay, I'm going to pause the video there. In the next video, we'll touch on the 3 key cash flow management strategies.